Good evening, all. Welcome to the first in our webinar series with regard to selling or buying a dental practice. So this is week one of three. In fact, I heard up two. What's
Yeah,
going on there? I
yeah,
heard up
yeah.
two. This is week one of three. And the subject tonight is too good to sell. Obviously, next week you get to meet all of our team, I think, or some of our team over the course of the next 3 weeks. You've got Anna and Zach on what's selling in 2025, and then in the final week you've got my colleague Phil Kolodinsky talking more in respect of deferred consideration. But as I said, we started tonight's subject is too good to sell to a dental group, which is kind of where we're going to focus on. So as I said, I've been joined tonight by Julie Randall, who is one of our senior practice valuers. And Julie, do you want to give a very brief intro before we crack on?
Absolutely. Yeah. Well, as Luke said, my name's Julie. I'm one of senior practice valuers at Dental Elite. I've been working with Dental Elite coming up 6 years now in my role. I've successfully sold a lot of practices, many to corporates, which we're going to talk about tonight. So yeah, interesting to hear tonight's talk.
Great. Okay. So first thing I think, as we titled this too good to sell to a corporate, and I guess the first thing that we probably just wanted to spell at the outset is about the percentage of practices which actually sell to a dental corporate. Because when we do our goodwill reports, which we release biannually, so we release them normally in the May time and normally in October, reflecting the whole fiscal year in May and reflecting the first part of the fiscal year in the interim report, which we release in October, November time. Is we look at the percentage of deals which are actually selling to a dental group. And first of all, we break that down into the proportions of groups. So we have what we call the big five, which are tier one buyers. And then we have tier two, tier three, tier four, and then independent purchasers. So to briefly explain, independent purchasers are people who are buying their first or second dental practice, and tier four buyers, who I'm going to talk about a bit more tonight, who are people that buy, who generally own somewhere between 4 and 10 dental practices. So the first thing is the big five, as we refer to them as, which are kind of the top tier, sort of, talking hundreds of dental practices. The reality is they're nowhere near as acquisitive as the urban myth would have you believe, is that in our last goodwill report, they bought roughly about 3 to 4% of the practices we acted on. Whereas conversely, independent purchasers, which, as I said, people buying their first, second, or third practice, they bought roughly about 70% of the practices we acted on. So there is this kind of mid-market bit, if you like, where which give or take represents about 24, 26 odd percent, which are people who own multiple dental practices, but they're not sort of up there in sort of multiples of hundreds. And indeed, I think what we've seen sort of over the last sort of 12 months or so is a real rise in what we call our tier four buyers, which is that sort of 4 to 10
Yeah.
mark. And I guess the reason for that is, and why we think that's happened, is that if we sort of dial back a bit to sort of 2020, when of course we had COVID, as a lot of those buyers were hit by the practices that they owned, and there was a lot more nervousness because they tend to be locally and more independently operated, and they didn't really make any real acquisitions at all for sort of the 2 to 3 years after that period in time, as a group. So what we saw is that they've used the last sort of 3 or 4 years to really pay down their debt. And when you're at a tier four buyer, technically you're normally borrowing the 10-year money as opposed to 15 or 20-year money. So bear in mind, most of them now have got debt to equity ratios of somewhere in the region of about 40% debt, 60% equity, and part of that's through organic growth, where they've had the business and they've grown them, because a lot of dental practices have grown quite a lot over the last few years, but also where they've used that period to pay down debt. And part of that, again, was because there's some nervousness around the cost of debt. But I think what has happened is that now we've sort of gone through a period of real uncertainty. We're now only in a period of uncertainty, which I say slightly tongue in cheek. But I think most people think that, generally we're now on a downward trend for interest rates. Now, it may well be that they don't come down quite as fast as we thought they'd when they come down 9 months ago. But generally, the perception is we're still on a downward trajectory as opposed to kind of anything else. So I guess, to return to the subject of sort of what too good to sell to a corporate, about sort of whether a practice should or shouldn't sell to a corporate, I think it's probably useful at the outset to talk a little bit about the history of corporate acquisitions, because of course, if we dial back to 2006, which was when there was a relaxation in the changes of the Dentist Act. Now that date might make more resonance to some people because of course it was around the same time we had the introduction of the new NHS dental contract, which we still refer to as new some 20 years later. Is that they brought in the relaxation of the Dentist Act, and what that allowed for is a lot more corporate investment in the dental space, and we've seen that gradually sort of come and go over the last 20 years. We've had periods of real consolidation, and then we've had periods like the last year or so where that consolidation has slowed down a little. But what has changed over that fullness of time is how a lot of the dental groups approach acquisition. Because originally, and if we sort of go back sort of 5 or 6 years in the more recent history, it was all about EBITDA land grab. So it didn't really matter perceivably, about sustainability of EBITDA or about growth. There was talk about it, and of course there was lots of sort of elements of deferred consideration. But we were in a really, really competitive environment. And generally, the guys who were buying these kind of practices en masse were backed by private equity, and the private equity holds were often touted to be a lot shorter. So what you often saw was private equity coming into the dental space, and they were doing these buys in the buy and builds, and they were doing them and looking then to churn them out within sort of 3 years or so. So to coin an expression about holding the baby is a lot of the time they were only holding the baby for sort of
short periods of time. Yeah.
Short periods of time before it then became someone else's problem. And the other big change, of course, is that what we have seen more recently is that when these groups do change hands, it's historically when they used to change hands, the entire senior management team didn't stay on, or if they did, they stayed on a very consultancy style capacities. They didn't have any real accountability for the business's performance beyond the completion after they bought it, or if they did for a very short space of time. Whereas now I think private equity have become a bit more savvy to sort of how dental transactions work and about some of the risks involved in dental practice acquisitions, and also they've seen some of the casualties of where it hasn't quite worked out, and particularly I guess probably the biggest one is the Carlyle Group, who of course backed IDH, or what is now My Dentist. And they held that for probably one of the longest holds in private equity history, where they were almost caught holding the baby, and all of the walls came off, and there was all the challenges with regard to NHS recruitment, and they couldn't sell the business unless they sold it at a significant loss, because there wasn't really that kind of interest level. So now when people are approaching kind of corporate M&A, what they're looking at in the dental space is they're looking about sustainability, and they're looking at the fact that the chances are a lot of the people who were responsible for making the kind of offers and for making those kind of acquisitions are probably going to be the same people who are going to have some kind of accountability for it further down the line. So what they don't want to do is, in the run up to a sale or a change in main equity provider, is they don't want to buy a load of stuff that then all of a sudden is going to create them loads and loads of problems beyond completion. So I guess to put a headline on it is they're probably buying more responsibly.
Yeah. Absolutely.
Than what they perhaps were. Yeah. There's been a few lessons learned, should we say? So I guess the other point to probably understand is a little bit about sort of how a corporate acquisition looks, and sort of the whole purpose, if you like, or MO around a corporate acquisition. So to do that, I'm going to share my screen very briefly with a very, very basic presentation, just to kind of highlight a broad point. So if you bear with me 1 second, I am going to share my screen. We're using a new Zoom software tonight, so you bear with me a second. I'm struggling a little bit with with technical details. Hence, we were a little bit late tonight, but I think we got there. There we go. So what you're looking at now, and you are seeing it right, because I said it was basic. It is basic. You were looking at a screen with 12 square blocks on it. Now, those 12 square blocks represent 12 times EBITDA. So every square representing 1 turn of EBITDA. Now, I imagine that most of you watching this webinar or watching this recording have an understanding of EBITDA is. But for those that don't, Julie, EBITDA?
EBITDA is earnings before interest, tax, depreciation, amortization. So in essence, that means just removing anything that's personal to you and calculating what the clinical profit is within the business.
But so in dental practice terms, it's the true operating profit, and it's associate led in the context that we're talking about it. So when a group is looking to exit, what they're looking to do is a typical exit multiple now for a group is around 12 times EBITDA. So just to caveat that before I get shot tomorrow, is that's not what dental practice, individual units of dental practice are selling for, but that's typically what a group exit is being targeted at this point in time. And yes, there have been exits at a lot higher multiples. A Portman refinance once, and the Bupa Oasis deal was a lot higher than this, but this is where we are, roughly speaking, in today's money, where debt is a lot more expensive, and as I said, where dentistry is viewed to be a little bit more risky than it was previously. So the first thing that happens is within that 12 times, there is a good 1.5 times turn, which will be attributed to head office costs. So that in essence, the owners of the group aren't benefiting from the first 1.5 times that they sell on for, because they would have picked up extra costs when they sell your business. And of course, different corporates approach this different ways. So there are some very nimble groups out there who have a lot less infrastructure, and equally there will be groups who have, some would argue, have very bloated head office structures. And of course, it's that there's different levels of opinion, which I don't propose to talk about now, as to about the pros and cons of both. Now, but the reality is that if you are selling to a group, is that what they will be budgeting for, and what will probably occur is that for every acquisition that they make, they'll probably need a little bit more time in finance, in payroll, need a little bit more time maybe in marketing, a little bit more time in ops, whether that be an ops director or whether an area manager. And there's all these additional sort of staff costs that ultimately build up. And of course, there will be other costs associated with head office, which get you to lose about 1.5 times term in the first instance. The second instance is what we allow for in the salmon block there, is about the cost of acquisition. So I'm talking about the stamp duties, the legal fees, the accountancy fees, the broker fees, dare I say it. But there will also be, they will allow for some slippage, because with the best will in the world is that, and we talk a lot to M&A managers about, the performance of practice post completion, is that there will be practices that they buy that don't quite work out or that slightly underperform. And inevitably, in a lot of cases, there will be times where, because that sort of year one post acquisition, most M&A directors will tell you that's the trickiest year, because that's the year when you spend a lot of time bedding down the practice, where there may be changes in the team, in personnel, not necessarily just dentists, but even nurses. But of course, that will often slow down the dentist. So there are different elements of slippage potentially. We put, for this purpose, this model at 0.5 times multiple, but it could quite easily be more. So that takes us down to 10. And then, of course, we've got what they paid you in the purchase price. Now, again, don't shoot me now, is I've used 7.5 times block here as for what they're roughly going to pay you for a given business. But of course, that will vary from individual practice to practice, which is what we'll come on to in a second. But the main point probably to express on this particular point is the 2.5 dark blue blocks that kind of are sitting there still remaining in the middle. And that, in essence, is what you want to describe as the fat or the meat on the bone. That's where the group looks to make their profit, if you like, on exit. So they want that 2.5 times, or those dark blue blocks, to be absolutely maximized, because if they're not maximized, then in essence, what was the point in kind of doing the acquisition in the first place? And I guess that's kind of where we want to sort of return to kind of what the theme is for this particular webinar, and kind of where we think groups are looking to acquire at the moment, and more importantly, where they're not. Because of course, what they will look at is your potential risk of slippage. And whereas before, where we had the EBITDA land grab, is that because the holds were a lot shorter, the EBITDA slippage was less important because there was less time for the slip. But secondly, now what we tend to find is that if they think there's going to be a large degree of slippage, or there's a high probability of a large degree of slippage, then actually the interest in the practice just isn't there. And in fact, obviously, Julie used to work in dental practice, didn't you? Because the biggest risk, of course, is high grossing private associates.
Yeah, absolutely. And, if they decide to leave in that first year, when you're bedding in, the cost of recruiting and the cost of getting them back in and getting somebody with the same degree of competency and grossing is just going to really slow you down.
Yeah. So what we tend to find, so I guess point number one, if you like, which is taking a long time to get to point one, but point number one in this particular webinar is about that if you've got a practice where you've got some really high grossing associates, there's two things that happen. Either realistically, you're looking at selling your practice to probably not one of the bigger dental groups, but probably one of the tier 4 consolidators I mentioned, who can be more flexible, because whilst it'll probably be a relatively unpopular opinion, I think it is a generally accepted opinion that actually localized operators who are on the ground on a daily or weekly basis have got far more probability of successfully transitioning that goodwill than one of the bigger groups. And that is reflected often in the deal terms that they give. So that's the first instance. The second instance is that they just pay a lower multiple. So when I've got these green blocks on the screen here, is they'll go, well, actually, we think it's far more likely, the salmon block, so the slippage is going to have a greater probability. So we're just going to pay less for the business in the first place, which again then returns us to the point of well, why? Well, if that's the case, you might as well look at other opportunities. And sometimes, particularly with specialist practice, which is probably the other group that we've put together in this group, really specialist practice, maybe save for orthodontics, because orthodontics is a slightly different kettle of fish. But if we're looking at other specialist types of practice, where arguably there's other risks, i.e., you've got a high grossing principal more often than not in these cases, or you've got a situation where the referral pathways might dry up because they look to internalize it, or, there's a political thing locally where they don't like the new acquirer, is that actually it may well be that you look at it and go, well, if someone's only going to give me a lower multiple of EBITDA, actually, would I do better holding the business for a couple more years, pocketing two and a bit years worth of EBITDA, and then selling the practice without all the stringent deal terms, as we kind of, later on down the line. And again, you've got a real live example of this, haven't you?
I have, yeah, no, absolutely. And it's buyer dependent, isn't it, at the end of the day? But yeah, and it's also vendor, what you want and what works best for you. As Luke said, if you retain it for 2 years, benefit from that EBITDA, and then look to take a lower exit, and an exit that works best for you as well.
Yeah. So that's the key point. And the other aspect I think that's worthwhile considering about being too good to sell is the other way is that they want to make sure that they, in order to maximize the return on investments, the investments they want to make are investments where they can grow the blue block. So where there's easy fodder, if you like, of things that haven't yet been realized. And sometimes it's simplistic things. So if you've got a business that's already fully maximized, the chances are it's probably not going to work for a group. And by fully maximized, that can be any way of a number of things or a compound of all of them. So i.e., we're talking maximize income streams. So you're doing your perio, you're doing endo, you're doing orthodontics, you've got your
plan and
private, you've got your plan, you've got your average output per chair at £400,000 per chair, which can be quite hard to maintain if you lose an associate, as kind of Julie spoke about.
Yeah.
Opening hours is another one. If you're advertising costs, you're already exploring all of the free advertising. You've got really strong social media presence, and then you're not really doing any real advertising, and actually that kind of business means that there isn't really space to put anything else back in, or it could be the other way. It could be you're doing loads and loads of advertising, and actually you've got a practice which is doing loads of transactional dentistry, but the risk is the fact that if your £100,000 a year spend on advertising stops working, or indeed becomes more costly, because we all know Google AdWords can surf around quite a bit, and actually that could hit the EBITDA, then you become high risk. And then at that point in time, then again, you're either looking at paying a lower multiple, or you're looking at a situation where you may do better outside of one of the dental corporates, because there may be better deal terms which are more flexible to kind of what you're looking to do. But I guess returning to this point about what works for a dental group, is that what you tend to find is one way they're looking to tackle some of this in terms of the acquisitions that they make is by the means of deferred consideration. And if I just flip onto a typical corporate offer for a second, it's a typical corporate offer, and this is again a relatively recent live example. Is that they would make an offer, on an overall basis at £303 million for a EBITDA of give or take £425,000, which in multiple terms is about 7.1, or as it says on the screen there, 7.08 times EBITDA. Now, on the face of it, okay, that looks like it's probably not a bad offer when you consider the background of this practice, which I can't discuss now, but let's assume that it is a fair market offer for this particular opportunity. But what they want to do is they really want to make sure that this business continues to grow as it has done in previous years. So actually what the offer actually looks like is a total consideration of £3 million, of which, we then look to negotiate to say 78% on completion in this particular deal, which meant on the face of it, they're only paying 2.3 million at the point of completion, which is actually representative of 5.43 times EBITDA. And again, this point's worth mentioning because in terms of how a corporate structures the deal, typically most groups are using debt finance. So they'll be borrowing about 4 to 4.5 times EBITDA. And that's about the maximum a dental group. And when I say dental group, I'm talking the big corporates, as well as people probably north of 8 to 10 practices now, can borrow on any given cycle. So anything they're putting in addition to 4 to 4.5 times EBITDA that they are paying at completion, they are having to self-fund from retained profits. And that's where you tend to find is, it becomes quite a hard negotiation because you've got to look at availability of capital. But secondly, is that if they're investing that capital in your practice because you want a higher initial consideration, that's then capital that can't be invested in an alternative opportunity. So generally speaking, on these bigger groups, they want to hedge risk, but the other purpose of deferred consideration is to talk about sort of debt leverage and sort of making debt cheaper, if you like, by borrowing a smaller amount of money. So then, as is typical, the balance of this initial, or so the total consideration paid, £3 million, is then paid out over the following 3 years based on the maintenance of the practice as it stood at the point of completion. So in this particular example, it's give or take £230,000 a year for 3 years, which then, if everyone's happy and you've hit all of the hurdles, by the time you get to the end of year 3, you've hit 7.1 times EBITDA, you've got your £3 million, and in theory, everyone's happy. But as I said, from a group perspective, what they're looking at is they're saying, well, actually, it would actually be far better if we've grown this practice because then I've got far more fat on the bone or far more blue blocks, to use our example. So what we actually are seeing in most corporate deals now is a bonus. And again, I use the term lightly, I'm using the term they use, for reasons I'll explain now, is that in this particular instance, they're going to give this particular chap £687,500 in addition. So he'll get near enough £3.7 million for his practice that has an EBITDA of 423 grand, which on the face of it sounds pretty good.
It's amazing, doesn't it? Yeah,
we're on the 9 times EBITDA. But of course, in order to get that, he has to grow the EBITDA to £687,500. Which means that in practice, he's not getting 9 times because actually he's on the hook to make sure this business grows under various different parameters. But from their perspective, if you look back on reflection, the time he's got to the end of year 3, they've only paid 5.36 times EBITDA for this particular opportunity. Now, I guess all of the deferred consideration, if you consider the EBITDA was 423, is paid out of cash flow. So they're not borrowing any money for that because that 230 comes out of cash flow every year. So they've only really ever borrowed the initial 4 to 4.5 times. And of course, 687,500 significantly waters down the initial investment they made. Now, in theory, the vendor's happy because he's got 3.7. And in theory, and the buyer's definitely happy because they bought an opportunity for 5 and a bit times the EBITDA. Now, I'm not necessarily saying this is a bad deal at all, but I think it's important to understand how these bonuses work and why they work for some people, and more importantly, kind of why they don't work for others. Because I guess in this particular, guys, you've got to make sure that you understand how that works and that if you think there's a reasonable chance of you getting the bonus. If you don't think there's a reasonable chance of you getting the bonus, then clearly it's not worth the paper. It's not worth the paper it's written on. And also, you've got to have some confidence in the group that you're selling to, because, of course, once you've sold the practice, you've sold also the autonomy.
Yeah, and you've got no control over it. And how are you going to manage that?
And we have had people who've achieved the bonuses, and we work, and we try and speak to people a good couple of years after they sold the practice to understand how they're getting on and what life's been like, both from the soft side of things, but also from a performance basis as to how that's worked out for them. Because for using the live example that we spoke about just this afternoon, there was a chap who sold to a group, and he was expected to hit, in order to get his deferred consideration, £2.6 million in revenue this year. He didn't get his deferred consideration because the group hit 1.9 million. And the unit hit 1.9 million pound. Now, the reason it hit 1.9 million pound is his 2 high grossing associates walked out at various different points in the year because they weren't happy with how the group was running the practice. And again, that comes back, I guess, to the theme on this practice is, if you look at it, if this guy's only going to get his initial consideration, in practice, he hasn't ever sold for 7 or 8 times or anywhere near that kind of multiple EBITDA. He's sold for 5.5 times EBITDA because the group hasn't been able to run the business effectively post completion, and he's lost that element of autonomy and that ability to kind of manage his associates effectively. So the other thing we say is that, some practices, and again, my point about a local operator will often always run it better. If you've got a high risk business, you may look at it and go, actually, how well is this going to be run post completion, and how much confidence do I have in the group to be able to run it? And that's where we say to people to always do your diligence before you sell to a group, and in talking to previous owners and also to their associates, to make sure how happy people are. Because whilst you might look at it and go, well, if someone gives me £3 million, I don't care how happy I am for the next 3 years. What you also probably more importantly need to remember is that how happy are associates.
Exactly. That's a big thing, isn't it? Yeah. Keep your associates happy.
Because if not, you will only get a fraction of the purchase price. Now, I mean, this is a broad brush scheme about, corporates. Now, of course, there are exceptions to this, and sometimes it's about catching the market in inverted commas, because if you have got a group that is in the run up to exit, sometimes they will be a bit more gung-ho in the kinds of deals that they will do. They'll pay a little bit more money. They'll give you more aggressive deal terms because they know if they're selling for 12 times EBITDA, for argument's sake, that actually if they get your group in 6 weeks before they sell, then the practice is they don't need to pick up the extra head office infrastructure, and they don't need to worry too much about your performance post completion, because a lot of that will be dealt with in their initial consideration that they're getting when they sell out. So sometimes it's also about catching the market right. But what we want to discuss on this particular practice is what is sort of too good to sell to a corporate, and what kind of doesn't work. Thank you very much for listening tonight, guys. As I said, please join Anil and Zach at the same time next week at 7 o'clock, when they'll be talking about what's buying and selling in 2025. Phil in 2 weeks' time, when he'll be talking a lot more about deferred consideration. But for now, I bid you a happy new year and wish you good night.
Thank you.